KCP is a South Indian conglomerate that operates across three seemingly unrelated worlds: the housing market, Vietnamese sugar production, and high-precision aerospace engineering. Most investors value the company based on its identity as a regional cement manufacturer in Andhra Pradesh, a sector that is currently weathering a period of severe instability. This chart shows how a regional price war has impacted the business. With pan-India competitors fighting for market share in the south, KCP's operating margins have compressed to a multi-year low of just 5.2%. Because the market is focused on these distressed cash flows, the company is trading at a steep discount, with a valuation that represents only a small portion of what it would cost to actually build these industrial assets from scratch today. However, this singular focus on the domestic cement cycle obscures two highly profitable divisions that are providing the liquidity necessary to keep the entire empire operational. 3,000 miles away in Vietnam, KCP operates a massive empire focused on refined sugar and ethanol. Superior crop yields in the region and dollar-denominated pricing have turned this division into a steady cash cow, responsible for approximately 35% of the group's total revenue. This division provides a critical buffer for the parent company. In early 2026, the Vietnam operations sent a dividend of 56.66 crore rupees back to India to service the group's debt and maintain domestic operations. This is a textbook example of cross-subsidization. The profits from an overseas asset are acting as an internal bank, subsidizing the Indian cement business while it waits for its local market to recover. Without this Vietnamese lifeline, the rising cost of servicing 825 crore rupees in debt would likely have forced a much more painful restructuring of the Indian business. The second hidden asset is a specialized engineering wing that has spent over 30 years as a certified fabricator for the Indian Space Research Organization, or ISRO. In the aerospace industry, once a vendor is certified for flight hardware, they are rarely replaced. This creates a moat built on technical trust that is difficult for any new competitor to bridge. That trust is currently backed by a 420 crore rupee order book. KCP is building critical components for the Gaganyaan crewed mission and the growing number of private satellite launches in India. While the engineering division is currently too small to offset the volatility of the cement business, it represents a high-margin niche that the market's current valuation almost entirely ignores. Management is bridge financing the current slump, while they await the restart of the Amaravati capital city construction project in 2026. KCP's Muktiala cement plant sits right on the doorstep of the Amaravati construction zones, providing a structural advantage. Because freight costs determine who wins contracts, KCP's proximity lets them deliver materials at prices distant national competitors simply cannot match. To prepare for this demand, the company is investing in a dedicated railway siding and a waste heat recovery plant to permanently lower their transportation and energy costs. This is why analysts use a sum-of-the-parts valuation for KCP. To find the true value, you have to look past the consolidated losses and value the sugar, space, and cement divisions as separate entities. KCP's strategy demonstrates how a conglomerate can use specialized operations in sugar and aerospace to sustain itself through a cyclical downturn, buying time until its primary regional infrastructure assets reach their peak value.